Thank you so much. In the Vistage Confidence Index survey, two of the factors that we measure are CEO sentiment about prospects for both revenue and profitability. And these are metrics that are commonly used to measure the health of a business. Further, our research into the most common KPIs that are measured by small and mid-sized businesses has found that along with revenue and profitability, there are a variety of other KPIs and metrics that our CEOs use to measure their business. But the critical question is, what is most important? What are the metrics and KPIs that will help you understand and make data-driven decisions that impact performance and profitability? So today we'll explore the 4 decisions every CEO needs to make, how to determine the drivers of those decisions, and the data you need at your fingertips to make these data-driven decisions that ultimately result in increased profitability. Today's presenter is Vistage member Stephen King, CEO of GrowthForce. Stephen will share perspectives developed and honed from his 30 years of experience helping businesses improve performance, profitability, and growth with actionable financial intelligence. So as we proceed, please feel free to enter your questions in the chat pane and we'll answer them at the end. So Stephen, I'll turn it over to you to get us started.
Thanks, Ann, and thanks everyone. Welcome to How to Make Data-Driven Decisions. I like to customize my presentations based on the people who are in the room. And so we're going to start today with asking you a couple of quick polling questions. So we like to know, how many employees have you got? What industry are you in? And what accounting system do you use? Ann, can you launch that? Great. So is it just you, 1 to 9, up to 50, above 50? That'll tell us how big they are. While you're doing that, I'll just give you my bio. I'm Stephen King, President and CEO of GrowthForce. We're an outsourced bookkeeping, accounting, and controller service. I'm a 15-year member of Vistage, and I will tell you, I will never miss my Vistage meeting. I feel like I miss one page in the story of my members' lives, and it's the most important investment I make as a member. I'm also a CPA in Texas and New York, and chair the strategic planning committee for the Houston CPA Society. And a lot of the data we're going to look at today comes from both the research we've done with Vistage members in my speaking and the Houston CPA Society. So hopefully you'll find some value. All right, looks like we got the results of that. We've got 35% are 10 to 49 and 28% are 50 to 150. So it's about 60% 10 to 150. Perfect. Next question, Ann, is what industry are you in? And today what we're going to do while you're filling out that question, today what we're going to do is we're going to spend half our time looking at what are the decisions that drive profitability. I've studied hundreds of Vistage members and GrowthForce clients and looked at what are the levers you're trying to pull. And then we're going to spend the second half of our session on the data that you need. And we're not going to have the time to go into all of the details on the decisions, but we'll help you understand the basic drivers. So this is great. So that's the primary function. The second up is manufacturing, so I'll touch on that as well. And then our last question is, what accounting system do you use? Because that will tell us, I can give you some more specific details based on the accounting system they use. Now, I do a 3-hour Vistage session that really digs into the details of the decision-making process and on each of these core 4 decisions. We're just going to quickly go through those decisions, but if you do have questions, please put them in the question box and we'll answer them after this session to follow up. Okay, good. Again, one big winner. We got 38% using QuickBooks and the rest are not. So that'll give us some good guidance. So thank you very much, Ann. So again, the decisions that drive profits, we'll go through these pretty quickly, and then we're going to focus on what's the data that you need. And this is important because, as Ann said, the winners, I study the difference between the companies that are wildly successful, that are living the dream, that have 10 to 15% EBITDA, and those that struggle, have cash flow problems and management turnover and employee turnover. And what we found is, what's the difference between the two? The winners keep score. They have numbers at their fingertips to make data-driven decisions. And Gallup did a study that showed how the companies that have the leading earnings per share take their accounting out of the accounting department and put actionable financial intelligence into the hands of the decision maker. And that's a big difference from what most CPAs are providing. the whole accounting industry, and I've been a CPA for 37 years, is designed to look backwards, designed for compliance, to give you an income statement and a balance sheet that will help you look at what last month's cash balance were. So the receivables for people owed you 3 weeks ago. It's not actionable because it wasn't designed to be actionable. Those statements are critical. You have to have an income statement and balance sheet because the IRS needs to know that you're paying your fair share. The bank needs that to determine whether or not you can pay back the loan. The outside users, the board, the investors, that's who looks at the financial reports. I equate this to the box score in a baseball game. You can see last night's runs, hits, and errors. You can see who won the game. But to make decisions without the game, you need Billy Ball. And you need to be able to know if runners are on second and third and it's 84 degrees and the wind is blowing in, which do you bring in, the righty or the lefty? And that's what I think of as management accounting. Management accounting is like Billy Ball. It allows you to slice and dice the data to be able to have the information at your fingertips when you're trying to make decisions. Management accounting is cost accounting. It's about understanding the profitability of the work that you do, your unit economics. How much is the revenue and the direct expenses to earn that revenue over time in a trend? Now, the foundation of this starts with understanding the line, because then you can think about above the line versus below the line. So your top line is the income that you've earned. It's the work that you did that the customers are going to pay for. And on an accrual basis, you want to cut off at the end of the month and record the revenue that your employees earned, regardless of whether you billed for it or you got paid. And then what you do, subtract from that the cost to deliver those services, the cost to manufacture those goods. And there's two types of expenses in cost of goods sold. They're both direct expenses, meaning they're directly were incurred so you could earn the income. The first is direct labor. That's the cost of the people who did the work. In this case, it's an IT company, the cost of the help desk support, the on-site technicians, programmers, network administrators. The second type of direct expense, above the line expense, is direct materials. It's the cost of the stuff that you had to buy to serve the clients, and hardware, software, cabling. You take those two costs and that becomes your cost of goods sold, and income minus cost of goods sold is your gross profit. Now, I know this is pretty basic stuff, but it's important to have an understanding of this foundation for your business. What's above the line versus below the line? The below the line costs are the indirect expenses. They're not directly related to earning the income. It's not what the customer paid for. It's your overhead. It's your IT costs. It's your accounting, your HR, your sales reps. Now, a lot of people ask me, why is it sales above the line? Because it's cost of goods sold, Steve. Well, the customer is not paying for the work that the sales rep did. The sales rep creates an opportunity for somebody else to do the work. The exception is if their sales rep is also an account manager and they're having to serve the client. They have to eat what they kill, so to speak. Then a portion of those costs are above the line. And this is really important because once you understand the unit economics, the profitability of the clients you serve or the widgets you manufacture, then what we can do is we can attach fields and data in your accounting system that lets you slice and dice that profitability. You can see what industries are the most profitable or what sales reps generated the most profit and start to make data-driven decisions. So what we do is we start with what are the decisions you have to make. When you're designing your financial management system, you start with the end in mind. If you want to have actionable financial intelligence, what actions do you want to take? I love traction. Gino Wickman says what management monitors gets done. What do you want to get done? Start there. What are the decisions? Then, what are the drivers of those decisions? And then, and only then, should you start to create your financial management reports so you have that data at your fingertips. So let's go through what are the decisions. There's 4 of them. I've researched and studied hundreds of small business owners and hundreds of Vistage members over 30 years and looked at what are the drivers, what are the levers that you're pulling day to day, the decisions you're trying to make to increase profits. And there are 4 core decisions. The first is pricing. This will have more of an impact on your bottom line than anything else you do. This is worth spending extra time on. And the companies that have cash flow problems did not get pricing right. Once you understand pricing, then you got to go through and look at your existing book of business and figure out who are the bottom 15% of my customers or my products and services that are the lowest margin clients. Because if you've got limited resources, you'll probably want to reprice those or fire them and be able to make money on that limited resources that's on jobs that are priced right. The third is, how do you spend money to make money? How do you invest in sales and marketing to be able to get the biggest ROI? And when should you do that? And then the last is, how do you increase the productivity of your people? In a service business, payroll is your biggest expense. On average, it's more than 70% of your expenses. And so if you can get a small ROI by tweaking the productivity of those people, you'll have a profound impact on the bottom line. Now, there are other decisions. For example, cutting costs. If you want to increase profits, you can cut your health insurance. And if you do that by 10 grand, you'll make $10,000 more profit, as long as nobody quits. But there's no leverage there. It's a one-to-one relationship. And so these decisions are all about how do you get the biggest leverage in your business. The single most important decision is pricing. I can't tell you how many times sales reps come in and say, we're in a competitive situation here. If we can give them a 10% discount, I can close that deal. And we'll make it up down the line. We'll get after sales, we'll get referrals, we'll get a referenceable client. Well, if you've got a 30% gross profit and you discount your services by 10%, you have to sell 50% more business in order to make the exact same profit dollars. It's crazy. And conversely, if you can increase your prices by 10%, you can take Fridays off. And that's what the CEOs who play golf on Fridays have figured out, how to get that pricing right. Let me show you an example. And we have a calculator that we're going to give away as a follow-up to this if you sign up for our mailing list. In fact, in the chat is a www.growthforce.com/Vistage resources link, and you can go and get those now. And one of the tools that we'll send you via email is this calculator. This business has $100,000 worth of revenue, has a 30% margin, so they made $30,000. The sales rep, we needed that 10%. A lot of business owners think, I need the cash flow. Sure, I got people sitting on the bench. Let me keep them busy. I'd rather have some work than not. So they give that 10% discount, and now they made $20,000 profit. And in order to get back to the original full price, they have to sell 50%. They could go from $20,000 to $30,000 in gross profit. It has a profound impact on the bottom line. Now, a number of people submitted questions in advance. They said, how do we do pricing is why I'm on this call. That's a whole nother 1-hour session, and we'll follow up another webinar just on pricing. But the short answer is, you want a value price, but you need to know what's the floor. What's the minimum that you can price something in order to make your profit targets? And so your first goal is your gross profit. How much gross profit do I want to make? If I want a 30% gross profit, I can add up my costs and back into that number. But you also want to take your total overhead dollars divided by your number of widgets. If you're a service business, number of billable hours. If you're in manufacturing, number of widgets you push out the door, and come up with an overhead cost per widget sold. And that'll tell you, you can't go below your gross profit target and your overhead per widget, per billable hour. And do the same thing with your profit target. If you want to make a 10% EBITDA, then what you've got to do is look at your total profit target divided by the number of billable hours in a year, all your people times their utilization, and come up with a profit target per billable hour. And this way, when the sales rep comes in, says, I need to give a 10% discount, you can make a data-driven decision to say, do I sign up this client because they are a strategic partner? Well, if I give that 10% discount, it's all going to come out of the profits per unit. If you give away more than the profit per unit, you're not covering your overhead. And that's where cash flow problems come. The second decision, once you know how to price your jobs right, and you know what that target revenue target is, Then you've got to go through and identify which of the clients you should fire or reprice. We've got a couple of stories here we'll share with you. One is Liberty Pipeline. It is a pipeline services company that spun off from Enron and had a nice, healthy, high seven-figure business, but struggled with cash flow and profits. They used a factor to pay payroll, and they assume that's because it's the big energy companies are slow to pay. But when reality is, their issue was pricing. We partner with Insperity, and we were able to automate time-driven, activity-based costing by taking their labor cost divided by the timesheets and come up with a labor cost per hour paid, and then assign that automatically back inside QuickBooks for every customer, every job, every service item. So you could see profitability by customer, by job, by service item. Alan was pricing his jobs thinking he had a 20% margin because that's the industry standard, when he didn't really understand the fully loaded labor cost, the burden of all those people. He had time leakage that he wasn't including in his bid, travel time out to jobs that he was paying for and not getting paid for. He had project managers that were buried in management costs. Those are all above the line costs. And by showing him that he had 8 to 12 margins, he was able to go back to his clients and change his pricing and increase his profits. $1 million in the first year. He sold that business 3 years later for 8 figures. How? By looking at profit and loss by customer, by job, by service item, and going to those clients that have the lowest 15% margin and giving them 3 options. First, you show them the value that you're not getting paid for, the time leakage, the stuff that your service staff, who are servants, happily gave away to their clients in order to keep the client happy, especially your big clients you have to keep happy. What happens is that value goes out the door. And if you can capture the actual costs on every job to see the time and the expense of the cost of the people and what they're doing, you can go back to the client and say, I need to adjust our fee to reflect the project managers that I neglected to put in our contract the last time. I have some travel costs that I need to include in the next contract because I'm paying people to go from Spring, Texas to Louisiana to work on a pipeline. And you'll remember the next time you do a bid to include the iPads and the laptops and the extra hidden costs that should be in the bid. And what we found is 80% of the time, our clients' say yes, because they need good subs. They need a project manager. They see the value, and people make decisions to avoid risk. If you do good work, your clients are not going to want to take the risk of going to someone else. But if they have a budget problem, you can go with the second option and say, I can reduce the scope of our work and stay within your budget, but you're going to need to take over the project management. If that's what you want to do, that we can help work with your budget. Otherwise, I got to transition you to another service provider because we're not getting paid for the value that we're giving, and it doesn't work for our business. Over 80% of the times, the clients don't want to leave, and all that additional funding goes right to your bottom line. Decision 3 is, how do you invest to make money? This is really hard. Marketing expense is not just clear. So what we suggest, you can do it at a macro level and look at what is the lifetime value of your customers. You look at that profit margin that they make and multiply it by the amount of time they're going to be with you, years or months. Then compare that to what does it cost to acquire a new customer? And that's a really important data point when you're making sales and marketing decisions, because you got to look at the ROI by seeing what does it cost versus what is it worth. The cost to acquire a customer is really simple math. You take all your sales and marketing expenses, and in your chart of accounts, that should just add up to total sales, separate from marketing because they're different. Take that total expense, which includes all the salaries, all the taxes, all the commissions, all the fees that you pay for search engine optimization, for hosting of your website, everything related to sales and marketing, divided by the number of new clients you're going to get in a year. That'll give you a cost to acquire one new client. If you get a lot of business from existing clients, you can do the same math and see if you can allocate some of those costs. And what that does is it shows you what's the break-even point. What's the point that when you get a new customer, the profit that you make on that customer covers the cost to acquire that customer. And then when you know that, then what you can do is go into the accounting system. Most people are using QuickBooks. You can go in and add a custom field on the customer record in any accounting system to be able to start running your gross profit reports based on the decisions you're trying to make. You're trying to decide whether or not you should sponsor a trade show, add a field in the accounting system that says lead source. You can then run your client profitability report by lead source and see which lead sources generate the most profits. We know now from decision one that not all sales reps are created equal. Some of them are selling value and able to add an extra 10%. Others only see you as a commodity and they don't understand how to sell that value. So they're the ones coming in and asking for that 10% discount. When you're going to hire a new sales rep, run that profit and loss by sales rep report. And now you can see who are the ones that are worth replicating and should train the new ones. Marketing wants to know what goes on the homepage, figure out what profitability by industry. And I love this story because Art Saxby is a Vistage sponsor and a client of GrowthForce. He has no accounting staff. We do everything, billing, collections, bill payment, financial reports, everything. But my favorite story here is that he's got outsourced chief marketing officers all across the country, 65 of them. And we picked him up at the very beginning when we just designed his QuickBooks system, when Art started Chief Outsiders. And we worked all the way through to helping him be able to have actionable financial intelligence. But one of the decision 3 that he made was, I got a bill, this is 3 years ago, from Vistage to be a platinum sponsor again. It's a big bill, 6 figures. We're a partnership for tax purposes. And I don't have 6 figures of cash in the bank because we distributed it out at Christmas. And so I'm going to pass on sponsoring. But before I do, I thought, can you guys tell me how much revenue we got from our Vistage sponsorship last year? And we emailed back and said yes. But he was asking the wrong question. He should have been asking, how much profit did I get from my Vistage sponsorship? And he got 4 times more profit from his Vistage Platinum sponsorship than anything else that he did. He's like, oh my God, I almost didn't do that. My gut told me the timing's not right, but his data told him he needed to double down. And so now you can use that actionable financial intelligence to help make sure you don't make that decision to lose your biggest opportunity for sponsorship. And the last decision, and my favorite, is how do you increase the productivity of your people? In a service business, it's the biggest expense by far, 70, 80%. In a manufacturing business, it's the second biggest expense. So what you do is you want to make a shift from looking at your people as an expense to as an asset. If something's an expense, you want to pay as little and have the cheapest health insurance and hire late and fire fast and just cut that cost as much as you can. Whereas if people are an asset, what do you want when you invest in a stock? You want to see that stock grow. You want to see the stock price go up. You want to get a dividend back. And that's what happens when you think of your people as an asset. You want to identify who are the ideal people. What are the behaviors? Recruit for those behaviors. And then how do you give them clear written goals? And then reward and recognize the people who achieve the goals. That's another session that we're going to have, a people workshop. And how do you build high-performing teams? But today you just need to know that there's 2 hours a day that are being wasted by the average employee across the United States. Most Vistage CEOs say to me, that's it? Have you been in my office? Nothing happens before lunch. And the numbers are staggering. In 15 minutes a day, 5 days a week is an hour and a quarter. On a 40-hour work week, that's 3.125% of the whole week. If you're a $3.2 million business, 15 minutes a day translates to $100,000 for each $3.2 million in revenue you got, for each 15 minutes a day that you get back in discretionary effort. Now, you're never going to get back the whole 2 hours. You don't want to. People join companies and they quit bosses, and you want your bosses to have time to relate to their employees as people. But what you can do is understand that the single biggest reason why they're slacking, and therefore you have an opportunity to get back 1 out of those 2 hours every day, is because they're not being challenged. We give them an 8-hour job. People are smart. They get into a routine, get the work done in 6 hours, and now we can focus on fantasy football and the shopping on Amazon for the holidays. And so Harvard did a landmark case study and said, you can increase your likelihood of success by 82% by the simple act of writing down goals. And if you cascade those goals down to the department, and from the department down to the team and each individual, what will happen is you're going to get discretionary effort from your staff. You're going to get one of those 2 hours that they've got free working on these goals. Why? Well, surprised me when I read the report was because of Maslow's hierarchy of needs. We all have a need to be part of something bigger than ourselves. And when you feel like you're part of a team, you're not going to let the team down. And so by having a budget and cascading that budget to the department, and then looking at the activities that are needed to be successful on each team for each person, and you put that in writing right above their desk, and they walk past the copier with their coffee, sit down in their cube, they can see what success is, then you're going to get discretionary effort. And if you measure and reward and you recognize, more even important than reward is recognition by the boss, then you're going to get them to start acting like owners. That's a whole separate session. We'll come back to that. But we do have a client with Insperity that was in that exact case. Their IT consulting company, similar to Liberty, high six-figure revenue, struggling with profits and cash flow as a result. And we implemented job costing to see that their biggest client was their worst client, their lowest margin client. In fact, it wasn't even covering its reflective share of the overhead costs. It was a giant technology company, one of the big ones. They were proud of it. It's on their website. But it took us 6 months to talk about, we have to go back to them and tell them of all the value that you're giving away and all the costs that were missed in their contract. And they were afraid if we lose this big contract, it'll kill our profits. When in fact, we showed them the opposite. You can take those resources and put them on new business that's priced right. So they went back and they showed the big giant technology company what the real value was. And they said, oh yes, sure, of course, we need to pay for those project management costs and investments in your technology. They had increased their profits by over $1 million in 6 months. And then in the next year, they repriced everybody, and now they've doubled both their top line and now their bottom line. So that takes us to, how do you do that? Well, you have to have actionable financial intelligence at your fingertips when you're trying to make data-driven decisions. So how do you do that? Let's share some of the best practices that we've developed over 30 years about how do you build key performance indicators. The first is you need to track one driver per scorecard on the left axis. You don't want to have, some people say, Steve, show me the sales and the number of sales reps or the number of offices we opened on one chart. That makes the x-axis go too big, and that eliminates the shark teeth. We want to see the ups and downs, the change that happens over time in minute detail. The second best practice is you need to have a budget. If you don't have a budget, not only are you not motivating your staff to give you discretionary effort because they feel like they're part of a team, but you're missing half the value of your reports. The reports are not just about what were the actual results. The reports are also, how did that compare against what your expectations were for that same period? The budget versus the actual. In our charts, and this is coming out, this is a chart that comes out of our KPI template that we're giving away free to anybody who goes to growthforce.com/Vistage resources, and there's a link in the chat. And it shows you the budget, the actual, and it shows you the trend, the direction that's happening. And what it also shows you is actual results with trailing 12 months. Now, if you walk away with one thing today, it should be, what is trailing 12 months? Because most businesses have some seasonality. And at the very least, you don't have an accounting department that's really closing the books every month and making sure that that P&L is accurate. There's a lot of things that throw it off. Even if you've got a good accrual system, if you've got biweekly payroll, twice a year, you got 3 payrolls. Can't tell you how many businesses I see say profit, 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 loss, profit, 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 loss. It's like, what happened here? Oh, we had 3 payrolls. Well, That's not an accurate reflection of that month. You didn't hire any more people. They didn't work any more hours. It's just the timing of a monthly close. And what happens is that income statement is wrong those 2 months because payroll is off by 50%. You got an extra payroll. And the other 10 months are wrong because you're missing 2 payrolls. And so what we recommend is if you don't have that clear cutoff, use trailing 12 months. It's an XY chart where every dot on the chart shows you the total for the prior 12 months. So in this case, this business was a $3 million business in July 2017 and a $3.6 million business in June 2016. And the difference from month to month is the difference between the month that got added, in this case, August 2017, and the month that got dropped off, August 2016, 13 months ago. And so as that's going up, you'll see that the months that get added are getting better or worse than the month that got dropped off. But what happens here is it takes out of account all the seasonality. If you've got any aberrations from month to month, you can see the true economic result when you use trailing 12 months. And there's some really great examples here about how different it is. This is an actual business that looks like they're doing really well because their chart has a nice trend line. But what happens is when you're in your actual results, month to month results, the trend line is going to be a direct relationship between the highest number and the lowest number and the timing of that. And if you have a big Christmas season, you're going to show a big profit, in this case in October, because they had a Halloween business, I guess. As that big dot moves left, that chart gets worse and worse. And that may or may not be the truth. Whereas if you look at trailing 12 months net income, it is the truth. This is exactly what happened. These guys are actually in trouble. They've gone down from 1.5 million to 200,000 was their low in August. And they really need to look at that overhead cost. We also recommend you look at trailing 3 months. Trailing 3 months is a leading indicator of your trailing 12 months. Trailing 3 months is what you would expect. It's the last 3 months total. In this case, it shows you the last 3 months of net income. And when that light gray line is below trailing 12 months, your TTM is going to go down. And when that trailing 3 months goes above, you're going to start to see your trailing 12 months go up. And that's important because trailing 12 months, it's a 2-year trend. This is a data point for the year ending July 17, and this is a data point for a year later, June 18. So this trend line shows you what's happening as last year compared to this year. It's slow to move that big of a driver. And so trailing 3 months will help you see, all right, are the decisions that I made over the last 2 or 3 months helping us get better? And we show all that in our one-page company scorecard. We've got this document that we deliver to our clients and we give it away to our prospects and so that you can start to look at the most important drivers of your business. Every business needs to pay attention to 5 things: gross revenue dollars, which is your top line revenue, what you earned, regardless of whether you build it or collect it. Your gross profit, as we talked about, is the profit that you make on that dollars, and your net income. Those 3 drivers, we suggest you add to that the gross profit percent and the net income percent. Why? Because you may be growing the top line and the gross profit dollars and even the net income dollars, but if you're not operating as efficiently as you should be, if you're growing your people and you're not onboarding them quickly, you can still grow your dollars in gross profit, but your gross profit percentage will show that it's going down. And you're not as efficient with this new business, with these new employees as you should be. And that helps you figure out where do you invest in training and career development and help you increase that productivity of the people. We suggest that you look at your company scorecard both from an actual scorecard with trailing 12 months side by side, because you need to see both. You need to see the top, you need to see the actual results and the macro direction. So let's look at it. Our gross revenue charts show you on the left-hand side how does revenue compare to plan? And you can see that the green line is growing, the actual results are growing faster than the budget was projected to be. And on a month-to-month basis, the end of the year is better than the beginning of the year. So that line looks good. In this case, the trailing 12 months trend is the same. You can see that they've grown from $3 million to $3.5 million, and they're actually exceeding their planned budget for gross revenue for the last 3 months. What I like about these charts is it shows you the impact of turnover on your business. Turnover is one of the biggest expenses you've got. And there's no line item on the P&L that says employee turnover expense, but it can cost you 100% of the salary when somebody walks out the door. And so what we suggest is you look at the gross profit line on the actual results to be able to see if you are a service business and you make money on someone's time, then you will see that when somebody leaves, you've lost that billable opportunity, and the new person doesn't know where the supply room is yet. And so your gross profit percentage will start to go down. And if you, on the flip side, if you invest in the training of your people, or you invest in an ERP system or automation to help your people be more efficient, you'll see that gross profit percentage go up. And so I like gross profit because the most important number is gross profit percentage, because it helps you be able to see the effect of all the decisions that you make. The next the next report that we suggest is your net income. This is the bottom line that tells you how well are you managing the overhead of your costs, your gross profit minus your indirect expenses. And this chart is an actual chart, and it shows another example of where you have a company. If you look here on the left-hand side, they've got a lot of shark teeth. It's up, it's down, it's up, it's down, it's up, it's down. That makes it almost impossible to figure out what's going on. And this is because they don't have a good month-end close. They have biweekly payrolls. They don't accrue for revenue at the end of each month. Whereas you look at the trailing 12 months and it shows you the true story, what's really happened, regardless of how many payrolls, regardless of whether you accrued revenue and you did your billing on time, over a 2-year period, this will show you exactly what's happening. And oftentimes what I see is revenue is going in the right direction, gross profit is going in the right direction, but net income trailing 12 months is not. And it's because they're not getting the ROI from the salespeople that they were expecting. And that's our one-page company scorecard. We've got a toolkit that will make it easy for you to be able to fill this out yourself. It's an Excel template that we share with everybody in the Vistage ecosystem. It's got a company scorecard, a people scorecard, and ability to create up to 6 custom scorecards. You can track whatever it is that you want to track. You know, I know that one of the things that Vistage is advising is that we need to get ready for that inevitable recession that comes, or God forbid, a depression. And so you've got to now start getting the data that tell you, where are you making money? Where do you have opportunities to increase the bottom line? And what's nice about this template is we designed it. This is Excel. It doesn't look like Excel because we hired a programmer to put a form on top of it and make it easy for you to just be able to enter in 3 pieces of data every month: gross revenue, gross profit, and net income. And it'll automatically update your scorecard. In my Vistage group and in the Vistage groups that I've spoken to, we use this as part of a check-in. There's 2 reasons why people quit Vistage. One is because they got acquired. The second is they go out of business. And it's a terrible feeling when somebody's in your Vistage group who's not telling you what's going on and you didn't see the economics, and therefore you weren't there to help them. And so what this does is it allows you to have a 1-page scorecard that you can bring to your Vistage meeting and share it with your chair as part of your check-ins. And you can use this with your management team to be able to help teach them how the company makes money. We share with everyone in the business, because most of your employees think that your top line revenue is the same as your profit. Wow, they're rich, they got $10 million. And so what we suggest is you use this 1-page scorecard to show them how you make money, and then use it with your management team to be able to create custom scorecards where you can track financial data and non-financial data. We use this to track sales pipelines, how many leads, how many proposals, how many closes. We look at operations, day sales outstanding, employee turnover, whatever it is that you want to track, you've got the ability to create custom scorecards for everyone in the company to be able to use. And that allows you to be able to keep your fingers on the pulse of the most important decisions. So we have some time for questions here. Now would be a great time to enter some questions. I know that we got some from people before the session. So are there any questions that we should be looking at?
Yeah, so let's start with some that were submitted prior to today's session. One is how important is DSO as a key KPI metric? So this attendee used it at their last job, but don't know how to measure it at their current job. They do have a list of outstanding AR, but no DSO metric. Would you share some insights around that, Stephen?
That's a great question. Oh, I love it. Before I skip this page, this is the link. These are the 3 things that are on that page. You'll get this company scorecard that you can fill out yourself, or if you want, we'll fill it out for you. We also have a report matrix that has all the reports that you need at your fingertips and a step-by-step guide to help you figure out how do you implement all the things that we covered today. So DSO, let's take a look at DSO. I love DSO. Days sales outstanding. This is a really important number for you if you have any kind of cash flow problems. Because what it does is it's a single metric that allows you to be able to tell you how good a job are you doing at collections. So you take your total receivables for the year as of the balance, right? Whatever period it is. So let's just say it was, through October 31st was yesterday. Divide it by your total sales, net of any discounts or any credits that you give, the real net sales, and divide that by 365. What that's going to tell you is how many days does it take you to collect the average receivable? Now, if you're in an average business, that should be less than 30, and that's what most business owners look for as a good measure. We take a whole different approach. For Chief Outsiders, it's a great story. What we help them improve their cash flow to get it down to 14. And here's how. I did an Inc. 500 presentation a couple of years about best practices in cash management for small businesses. Studied what do the Fortune 500 companies do. And one of the things that I loved was when you sign a new client to a proposal, the first thing that Chief Outsiders does is in their proposal says, you're going to get a call from our growth force, our accounting department. And Kyle calls up and says, hi, I'm Kyle. Congratulations on joining the Chief Outsiders family. My job is to make sure that it's easy for you to comply with the financial terms. Our bill is due on the 1st. And so I want to know, and this is a great practice, before you start any work, ask them, how do you pay your bills? What's the process for this bill to get paid? Who has to approve it? What is the date, if it's due on the 1st, that you need to get it? The 20th? Okay, great. Is there any attachments, any supporting documentation, receipts that we need to give you in order to get approved? Is there a multiple chain of command? And what you're doing there is you're saying, 1, we're serious about our payment, our financial cash flow. Number 2 is we want to make it easy for you. And so we use this tool called, drawing a blank, it's a collections dashboard that tells you on the 1st of the month, if the money's not in the bank account, it pops up on Kyle's scoreboard and says, we did not get paid. So you can pick up that client on the day the money's due and say, hey, I noticed that we didn't get the deposit today. Is there anything wrong? Is there any issues that I need to worry about? And what the research said is they use this as a service call to make sure that you're completely happy with our services. And then what'll happen is they'll realize the money is due on the 1st. And so you can get your 30 days is not the best. 10 or 14 days is what the best practices are. So there you go. And if I think about that receivable portal, I will make sure I post it.
Yeah, so I had a follow-up question to that. For the net credit sales, what's time period does that cover? So you mentioned, is this all year to date or month to date? What do you recommend for that net credit sales?
Great question. Thank you, Craig. It is exactly what the number is on the right-hand side of the formula. So if you're using 365, you're looking at 365 days of sales. Some people use 360. 90 days you could use. It's just The dollar amount is whatever that multiplier is on the right-hand side. Oh, I see a great question from Michael about gross profit. Why don't I include burden as a component of COGS? Michael, you are 100% right. That is not what I intended to say. When you're looking at your above the line direct labor costs, you have to look at fully burdened labor costs. You have to look at the gross wages, the taxes, the health insurance, the 401k. I include recruiting and training costs in my burden rate. So when I was saying, okay, I got a 31% burden rate, it's all of those fringe costs plus the cost to recruit and train. Because if I can lower my recruiting costs and my training costs of new employees, then that shows in a lower cost per hour. So I'm sorry if I didn't mean that. The burden has to go with the people. The above the line burden goes above the line, and the below the line cost also includes fully loaded labor costs.
Excellent. So let's go back to one of the questions that was submitted in advance. One of our attendees is interested in developing pricing for profit in a service-based business.
Okay. What's the question? How do you do that?
Yes. How do you develop pricing for profit in a service-based business? And you talked a little bit about productivity and billable hours. So, how do you develop pricing around that?
So I think I've got another slide here that shows you this. So the first thing you want to do is you got to understand, what does it cost you to do the work that you do? So your fully loaded labor costs, right? You have to look at that per person. Then divide that by the number of hours that they work. That gives you fully loaded labor costs per hour work. And this is called time-driven activity-based costing, TDABC, time-driven activity-based costing. And it's a game changer, because when you see the cost of the work that you do, that's the real cost, not what you think it is, not the time leakage and the project managers that you forgot about. Then what you can do is you work backwards from there to come up with your gross profit target. You want to make a 50% gross profit, and you got 125,000 of fully loaded labor costs in there, then you got to bid that job out at $250. What you also need to do, though, is if you need to do, as we said earlier, look at what's your target profit and your total overhead, and divide that by the number of billable hours that you've got. Usually people use 1,600 hours. You got 20/80 and about an 80% utilization. You got about 1,600 available hours per billable staff person. So if you got 10 billable staff, that's 16,000 of billable hours. And if you got, I'm not going to do the math here, if you got $1.6 million of overhead and 16,000 of billable hours, that's $10 an hour in overhead charges. And if you want to make $160,000 profit, you need another $10 an hour in profit. And so you can't offer any discounts below what that 50% target is, otherwise you won't cover your profit or your overhead targets. Does that help answer that question? Because that's an important one.
Absolutely. Yeah, thank you so much.
Let me add one more piece of color on this. What's really interesting is, if you're using QuickBooks, since most people are, you can automate this. Intuit Payroll and Insperity have this fully automated. None of the other payroll companies do. You can do it manually with all the other payroll companies. They'll give you a job profitability report, but you have to manually add the jobs into the payroll provider and manually enter the labor allocation inside QuickBooks. With Intuit Payroll, desktop only, they don't have it for online. And in Insperity, with both desktop and QuickBooks Online, when you run the payroll, you can get that timesheet sucked in, that labor cost pulled in, and then it'll take the fully loaded burden rate per hour paid and multiply it times whatever's on the timesheet, times the amount of time on the customer, on the job, on each service item, and each class. And since you're doing billing in your accounting system by customer, by job, service item, and class, you now have profitability by customer, profitability by job, profitability on each of your different service items, and profitability any way you've organized your organizational chart, by department, by team, by group. In Art Saxby, we can show him profitability by city, by CMO within a city, by Austin, by state of Texas, by the central region, and by the country. And that's what Intuit and Asperity let you do, implement that time-driven activity-based costing, and that's how you figure out your pricing.
That's fascinating. So you mentioned information by department, and we had another question that came in asking about resources for KPI scorecards for an individual department. And I noted in your scorecard, while you have the overall company metrics, there's the ability to add custom dashboards, I guess, if you will. So could you talk a little bit about how you can use those to track departmental metrics?
Sure, and if the person could post what industry they're in and what their departments are called, I can give them more specifics. But let me give you a good example. I have an interior design client who thought they were in the interior design business, and so she had most of her energies was out there trying to get interior design business. And what we found when we ran a profitability by department report, that the design business was like 30% margins, but the retail business of selling fabrics and window treatments and couches and floor rugs and all these fancy things had like 60, 50, 60% margins. And so we shifted her business model to focus more on selling window treatments. And her store was moved from a back office to a front office on the main drag. And that changed all the profitability because you could see which department was most profitable. Then within the departments, what we suggest is you start drilling down into the work that the people do, being able to look and see, do we make more money on large clients or small clients? I had one of our clients who was serving nonprofits, and Growth Force, 30% of our business is nonprofits. And so they were trying to figure out, did they make more money or less money on that industry? Another one was just working on right now, wants to know if they should go after schools or governments as their primary target market. And so the goal is to be able to look at that at a macro level, and then you want to drill down into the activities that cause profits, activities that cause results. So for example, if sales is a key department you're looking at. Oh, this is an operations.
Operations, yeah, thank you. I was just going to say this is operations and service industry.
So then you start looking at, in fact, you know what? I took the liberty of opening up some of my other PowerPoints in case somebody asked me a question. I think it's this one right here, operations. So you want to look at customer satisfaction. You want to look at what's the client retention. What is the realization rate? What's the revenue per hour paid? Billable hour. What is the revenue per billable hour? What is the realization is how many hours did they work over the revenue they brought in? And you've got really a couple of things you want to be thinking about, right? The high level metrics of accuracy and quality should show up in net promoter scores or at client retention. I like, what's your target for on-time delivery or, return authorizations. And net promoter score is a really great one. We use it here at Growth Force. You look at you ask one question. What is how likely are you to make a referral? I give a referral to a friend or colleague. And you take all the ones that give you a 9 or a 10 minus the 0 to 6s, and you look at it as a percentage, and it shows you how good a job are you doing. And then on operations, you've also got, what's the number of tickets that get closed for our IT clients, or amount of rework that you have to do, or how much, what percentage of your employees have downtime. Look at, we've seen clients that have a timesheet that says looking for work. So that in a service business becomes real important if people are looking for work. Megan, Moriette, I hope that helped answer your question.
Great. So I just wanted to come back to that decision number 4 that you talked about. Our next Vistage research report is on culture, and we've been really talking about how do you actually measure culture. So I was wondering, when you talk about improving the productivity of your people, how do you measure that? And are there things that are measures of engagement or profitability? What are some of those measures for people?
So that's a whole other hour session, right? That we are definitely going to do. I know there's been a lot of people who have asked for that kind of help, and I've got a whole project that I'm working on with Insperity to help look at the measurements. But you know, there's a number here. You know, employee turnover is number one. That's the single biggest hidden cost every business is going to have, and the average small business in America has 19% turnover. And so by implementing a human capital management strategy, which is basically 5 steps, number one is, why do you exist? What is your reason for being? What is the unique reason why somebody would buy from you? And it's usually the strengths and weaknesses of the founder. The second step is building a culture by design. That means defining what are the behaviors that are going to be successful in your business, and recruiting for those behaviors, and cultural fit, defining what kind of organization do you want, and finding people who are going to be successful. For Growth Force, we're smart. We have SNAP, meaning we're problem solvers. Our employees find meaning in serving small businesses and nonprofits. We are accountable. We do what we say. We're resourceful. We'll find out and proactively find out an answer. And we like to be part of a team. So we're not going to hire people who don't fit those core values, and develop that culture by design. Then you're going to create clear written goals, because Harvard shows that's what gets discretionary effort, gets people feeling they're part of a team. Step 4 is keeping score, keeping track of these actual results against the plan. And then step 5, the most important, is recognize and reward the people who contribute the most. So if you identify what are the drivers of success and then recognize those people, it meets Maslow's need for esteem and importance and self-actualization. So that's a short version of those measures. But I say you want to look at your employee turnover. You can look at this people scorecard we've got, shows you gross revenue per employee, labor cost per employee, and net income per dollar of payroll. You can also look at the return on assets. If you are treating your employees as an asset, if you look at the net income that you earn over the cost of the people, then you can see, are they performing like a stock would, giving you a dividend, increasing value. Is that helpful?
That is very helpful. We have a couple questions that we're not going to be able to get to today, but for Patricia and John, we'll be happy to reach out to you as a follow-up. There's a question about industry average data, and then KPIs for marketing. So we'll definitely make sure that we follow up with those. So Stephen, I wanted to thank you for sharing your insights. Obviously, this is not the last time we'll be hearing from you with all the insights that you have and the different kinds of decisions and data that can be collected. I want to thank everyone for attending today's webinar. And next Friday, please join us. Candace Morton of Insperity, who Stephen's talked about quite a bit. She's going to share 4 key strategies to retain top talent. And we do know from our recent research from Vistage that retention is actually topping the list of the top priorities for talent management challenges amongst CEOs of small and mid-sized businesses. So please, you can register for that if that's relevant to you. I suspect that it is. That's at vistage.com/webinar. That'll have a complete list for our upcoming webinars, and you can register for this one, and that's vistage.com/webinar. So thank you so much. There's an email on the screen if you have any questions. The website, the link you can follow to sign up for the scorecard is in our chat field. And I want to thank everyone for your attendance, and thank you, Stephen.
Thanks, Ann.